Hello everyone, this is Professor Kent. Today's video is regarding Chapter 6, Revenue Recognition. It is a big chapter, so we'll try to cover as much we can in this video. If I'm unable to cover the whole chapter in one video, then I will record another video for Chapter 6. So Chapter 6 is Revenue Recognition. As you see it, there's 11 objectives that we needed to cover in this chapter. When we're talking about revenue recognition, what we are doing is, as an accountant, we wanted to learn the accounting for revenues, when the revenue should be recognized. So, of course, accounting for when revenue should be recognized is complex. Yes, of course, we know that it's complex. Complexity is caused by structure of the sales transaction. So when we're recording a transaction, it is important to understand the business the entity is engaged in. So it makes recording the revenue easier if we know and understand the business the entity is engaged in. When we're recording a revenue, when we needed to do a journal entry, the first thing we needed to know is what is given up, and the second thing we needed to know what is being received. So you gave up something to receive something. So those are the two things that we needed to know before we can record a journal entry, or before we can record a revenue transaction. Now, when we talk about revenue or sales transaction, it involves what it does involve. It involves the transfer of a good, service, or both. So sometimes we have a sale that has we're selling just the goods. Sometimes we have a sale we're selling the service, and sometimes we have a both. When there's a both, then it makes a little bit more complex. It makes it complex. But when it's one or the other, it makes a little bit easy to recognize the revenue. The first one is sale of goods. And if you're selling a good, it is a tangible asset. When it's a tangible asset, when the control transferred to the buyer, and the buyer has the access to the benefit of the ownership. So you have an asset and you transfer that asset to the buyer, and the buyer is benefiting from that asset. It is called a sale of a good. So that means the legal, you would record the sales when the transfer of legal title and possession is transferred to the buyer. You recognize the revenue at that time. But when the second type of sale is a sale of a service. So when you're providing a service, when do you recognize the revenue? Of course, service is a non-tangible, so the possession and the legal title are not relevant. So at this point, legal title is not relevant, but could span more than 1 year. You could provide them a service within 1 year, or could provide a service longer than 1 year. Sale of goods and service combination. And sometimes what we do is we sell a good, and with that we also sell a service. So then what we are doing is our revenue will be a combination of two. Will be one will be a good and goods, and the other one will be a service. So then how do you recognize it? And this kind of when you sell both of them together, they are called as a bundle sale. So you're selling it as a bundle sales, and that means that we have multiple deliveries, and knowing when to recognize the revenue. So there's a multiple deliveries. Of course, when you recognize the goods part, when you transfer the title, the services when you provide them the service. So the next thing we needed to look at is what we received in return. So we gave up what we gave up. We gave up a good, or we gave up a service. So what did we receive in return? We receive a consideration. So this consideration can be monetary or non-monetary. When you provide a service, if the customer is paying you within a cash, or going to pay you within a cash, it becomes a monetary consideration. If they are going to pay you with a non-monetary item, is instead of giving us a cash, they will provide us a goods and service. For example, if you provide a service to the lawyer, you provide them the accounting service. In return, what they did is they provided you lawyer services. So then in that case, those services are called a non-monetary services. So that's what happens. Now it's saying and the terms are usually specified in the sales agreement. So any term, how they're going to pay us, they're all are all are specified in the sales agreement. When we do a sales agreement with a customer, the amount of the sale, the nature and the timing of the consideration, or the rights acquired, they are all included in the agreements. And then when also if your sale is related to goods, then we wanted to include in the agreement the quantities that we're going to be sending it to them, the nature of the goods, when are we going to send it, the shipping terms, all those are included in our sales agreement. So all the terms are included in the sales agreement. Now, when you sell it, we have to make sure the transaction is an arm's length. It is not. It is between the unrelated parties. So now this makes more sense. The value we sold is equal to value we received. So if you sell something, will be equal to the value we're going to receive. We're going to be receiving it in monetary or non-monetary. Going further, now the next term is it's called a concessionary terms. So those are concessionary terms. Are the terms of a sales normal, or there is a special deal? So the terms are going to be different if the sale is a normal sale or is a special deal. So when I wanted to talk about what do we mean by sale is a normal or a special deal, the next chart explains a little bit better. So when we go to the next one, these are some of the examples. If your sale is a normal, and if you're selling it is on a concessionary on a special deal, concessionary selling terms. So that is if you're selling it, it is a special deal sale. So it's a special deal sales. So what is different? The selling price for your the selling price reflects the normal profit. Of course, when you sell it, you will make some profit, but when you're selling it under concessionary or on a special deal, you will be selling them on a deep discount. So the price will be different to when you have a special deal. But for the normal sale, the price will be same. The term of the sale will be normal term. It could be 30 days. They can pay within 30 days or 60 days. But when you're selling it under the special deal, you can make these under the special deal, the term of the credit will be 90 days. And also when you have a normal sale, we only sell it to the the customers that are credit worthy, where under the special deals, we will sell it to the customer they are a little bit riskier than our existing base. Also, under the normal sale, the ship when ordered and ready to ship, where under the other difference, when we make a special deal sales, they are going to be shipped on a later date. For example, it could be maybe hold the inventory in the warehouse till the extended period because they are getting a special price. They're getting a special deal on their sales. Now, these are, and sometimes what happens is we extend the right to return. We extend those ones for if it's a special deals. So those are some of the differences between the normal sale and the special deal sales. Now, the next part of the transaction is the legalities of sales transactions. So now, legal rights, in other words, legal rights. The act of entering into sale agreement creates a legal right and obligation for both the entity and the customer. As a business and a customer, when you enter into a sales agreement, it creates a legal right and an obligation. It's a right and an obligation. So both for the entity and a customer. So when you do an agreement, a sales agreement, of course you the agreement, the contract agreement is another way of saying a contract. Contract law is most relevant as each sales transaction represents a contract with the customer. So what we're doing is when we are when we're creating a sales agreement, it's a contract between the entity and the customer. And then what happens in that this contract could be a written, could be a verbal, or could be an evidence. When we are saying a written, you could have a lawyer presented at the time you're doing a contract, or you can just do a contract between you and the customer. It could be a verbal. They could call you and saying that I want this kind of service. So that's a verbal verbal one. Or the evidence, when we think of an evidence, you walk into the store, you buy a chocolate bar, you pay for it, you have a receipt. So that, in other words, that is also a contract. So then you have an evidence. Your evidence will be the receipt that you get from the store for buying that chocolate. Now, when you have an agreement, you're going to be delivering goods. When you are going to be, if you're selling goods, your contract is to sell goods. And then when you are talking about selling goods, physical possession of the goods immediately. So sales contract generally identify the point when legal title and possession of the goods passes the customers. So now we needed to know when the goods are going, when you sell the goods, when it's going to be passed to the customer, at what point it's going to be their inventory. So in this case, the FOB shipping point is soon as the business sells soon as the goods are shipped out, it is customers goods at that time. FOB shipping point, soon as you ship it, the title of the goods are transferred to the customer. This says FOB destination point, the goods belongs to the business till it reaches the customer's warehouse or the customer's office, wherever we're delivering it to. Now, in this case, implicit obligation not specifically outlined in the sales contract may also be enforced under the common. Sometimes we cannot put everything in the contract. Sometimes we don't, if we don't put something in the contract, they're not outlined in the contract, but they still may also be enforced under the common or the other law. So when you have a sales agreement, we cannot put everything in there, but if you have a contract, they can be enforced. Now, when we're recognizing revenue, there's two approaches of recognizing the revenue. The first one is the IFRS 15. That's the one we're going to be using in this chapter. So all the revenue that we're going to be recognized, most of the chapter will be regarding IFRS 15, so which is called asset liability approach. And then we're also going to be, of course, some companies are following an ASPE approach, and if they're following an ASPE, if the company is a private company, they will be following an ASPE standards. If they're following an ASPE standards, then they'll be going through the earning approach. When we are doing IFRS 15, there is 5 steps of revenue. There's 5 steps of recognizing revenue recognition. So we are going to go through each one, and then we're going to, of course, every company's entity's business is different. So we're going to show you different way of recognizing the revenues. So the first one is identify the contract. So first one is identify the contract. The second one is identify the separate performance obligation in the contract. Then we're going to set the price. And then once we set the price, we're going to allocate this price to, if we have more than one obligation, we're going to allocate the price to those separate obligation. Once we have done that, then we're going to recognize the revenue of each performance of each performance. So these 5 things, these 5 steps is the process of revenue recognition. So let's go through the first one. First one is a contract. Identify the contracts with the customer. So what is a contract? That's step 1. A contract is an agreement between two or more parties that create enforceable rights or an obligation. It's a right and an obligation. Customer's right or obligation. It can be, like we said, that it can be written or oral. So we can write it on a piece of paper, or it could be by just talking normally, or somebody's phoning in and creating a contract. Upon entering into the contracts with the customer, a company obtains the right to receive consideration. So we have the right to receive the consideration, and they had the right to goods if you're selling goods from the customer, and assume obligation to transfer goods or a service to the customer. So we have the right to receive. So when we give them a product, we have the right that they are going to pay us in monetary or a non-monetary consideration. Now, the company does not recognize contract as a liability nor a journal entry performed until one or both parties perform their obligation. So we said that the contract, there's two or more parties in there. So when one person perform their obligation, that at that time we record the revenue. So in this case, it's called that the journal entry is not done till one of the party performs their obligation. So we cannot do the journal entry till one of the party performs their obligation, and once the obligation is performed by one company, that at that time transaction takes place or journal entry takes place. Now under IFRS 15 to contract is what is in the contract has a commercial substance. The parties in the contracts have approved the contracts and are committed to perform the respective obligation. The company can identify each party's rights regarding the goods and service to be transferred. The company can identify the payment terms, so the terms are there. Each party's rights are there. The contract is approved by the both parties, and then it is probable that the company will collect the consideration. I say money. When you think of you could collect the consideration, monetary or non-monetary consideration. If all these things are present, then it is a contract. Now this contract that we created, it can be modified. So we can modify the contract. If the contract is within a year, 6 months later, we can modify the contract. If you modify the contracts, then you have to meet two conditions to modify that. The promised goods or services are distinct, and then the promise increased by they're saying the contract modification can occur while the contract is ongoing. It is recognized as a new contract. So you have an existing contract. If you're making any changes to that contract, then you could keep it same. But if you change something in that contract, we needed to create a new contract. If that's the case, if there's two conditions are met, we have to create a new contract at that point. When do we create a new contract? The new contract is created. The promised goods or services are distinct. The price increased by the amount of consideration that reflects the standalone selling price for which the goods and services could be sold. So if you're increasing the amount and the price, so you're increasing the amount or the price of the consideration, then you have to create a new contract. Then it's not a same contract anymore. So if both of these conditions are met, then it cannot be under the existing contract. It will be under the new contract. So these are the two things that has to be in there in order for us to do a new contract. But if these two are not there, then we can make the changes to the existing contract. Sometimes we can change the date, so then the amount isn't changed. So then we're just changing the date. When you identify the contract with the customer. So now, when do we know when to identify the contract? So in this case, this example is a good example to show you when do we recognize the journal entry when we have a contract. So this is what we are going to do. On March 1st, 2020, Margo Company entered into the contract to transfer a product to transfer a product to Soon Yoon on July 31st. The contract is structured such that Soon Yoon is required to pay the full contract price on 5,000 on August 31st. So we enter into a contract. When did we enter into contract? On March 31st. So it just enter into the contract. There's no journal entry at the time you enter into the contract, because the obligation by one party or both party hasn't been fulfilled. So we just entered the contract. So Margo Company and Sunyun Company, they signed an agreement. When they signed an agreement, we at that time there's no transaction that happens. The contract. So then what they're going to do is on August 31st, what they're going to do is they are going to pay the full price, and at that time the goods will be transferred on July 31st. So they're saying March 1st contract is identified, no journal entry is required. On March 1st we just enter into the contract. There's no now can we identify if there's a contract? Yes, we can identify the contract that we're supposed to provide them the service. In consideration, they are going to give us the money, and the terms are already in the contract, because they told us when are we going to deliver the goods, and they also told us when they're going to pay us. So all these are the not rules, these should be in the contract. First is, when we think of a contract has commercial substance, are we giving them a good or a service? Yes, we are. The contract is approved by the both party. Yes, the both party agrees to that contract, because they enter into contract, they agreeing said. Identify each party's right. One party, Margo, is going to provide them the goods and they are going to receive the goods. Identify the payment terms. Yes, there is a payment terms. They are saying that we're going to deliver the goods on the July 31st, and they are going to pay us on August 31st. So all these when we identify the contract with the customer, these are in my contract. If they are in my contract, then it is a contract. Now it's just saying identify the contract with the customer. A contract is an agreement between two parties that creates enforceable rights or obligation. In this case, Margo has the contract to deliver the product. So that's what we're talking about. That's the first step, and the second step is now identify the service separate performance obligations. So separate performance obligation, is this a one performance or more than one? So performance obligation is a promise to provide a product or a service to the customer. Promise may be explicit, implicit, or possibly based on customary business practice. The product or service must be distinct, and the customer can benefit from it. If the performance obligation in a multi-obligation contract is distinct within the contract, then it should be accounted separately. So now if I think of it, I went to Tim Hortons, I got a bagel and I got a coffee. So now I bought it together, but this is a different product and this is a different product. If I can sell them separately, then I have to account for them separately. Now, if one product, what happens is I bought a, let's see if I can if I bought a latte. So what they did is they put a coffee in there, they put a milk in there. So can I separate the milk from the coffee? No, I cannot. So then it's a latte is the product or service must be distinct, means it's a one product that I'm selling, so it's not two products. So in this case, we have two performances. At this point, there is only one here at that point. Let's do the example for it. I think it might answer what the example that I was trying to give. Assume that Genus Motors sells an automobile to Marquardt auto dealers at the price that includes 6 months of telematics services such as navigation and a diagnostic. These telematics services are regularly sold standalone on the basis by the Genus Motors. I don't know if it's a Genus or Genus Motors for a monthly fee. So after 6 months, so they can enjoy the benefit for the 6 months. After 6 months, what they can do is they have to purchase it. So now what happens is there's two performances in this case. There are two performances in this case. What are the two performances? First first one is free, and the second one they have to pay it after 6 months. They are not, now they are distinct and not interdependent. They don't have to do one or the other. So they are not interdependent. So in this case, if you get a bagel, not necessary you have to get a coffee. If you have a coffee, not necessary you have to get a bagel. So in this case, they're not, they are distinct and not interdependent. So in this case, if you look at it, this was they are they are interdependent, where the other one was not interdependent. So let's see if we could give the next example. In this case, Softtech sells customer relationship software to Lopez Company. In addition to providing the software itself, Softtech promised to perform consulting services. So we're providing them a software, and we're also providing them the consulting services. We're doing two. So now, are they interdependent? They are, because if you look at it, you have to have you have to buy the software from Lopez Company in order for them to provide you consulting services, because then extensively customize the software to Lopez information technology environment for the total consideration of 600. So we wanted to know, is this a separate obligation, or it is not a separate? Are they interdependent, or they're not interdependent? Now, in this case, the customized software and consulting services have been integrated into one combination. Even though they're distinct, they are interdependent. One cannot be sold without the other. So in other words, one cannot be sold without the other. Just the coffee, the latte, you have to, if I'm getting a latte comes with the milk and it comes with a coffee. But if you think about a bagel and a coffee, I can sell them separately. But in this case, I cannot sell them separately. Either if it's a latte, they both goes together. It's a we combine two products into one, in other words. So it account as a one performance. So latte is a one performance, bagel and coffee are two performance. Now going forward, some sales includes an option to acquire a future good or service. In other words, sometimes what we do is we have a coupon in the boxes that we do. We have what we have is the next one is we're continuing with the separate performance obligations. Sometimes a sale includes an option to acquire a future good. So means this is when the coupons come in. So you purchased, in other words, you purchase a box of, let's say, box of cookies, and that cookie, there's a 50 cents 50 cents coupon on it. In this case, the customer will bring that coupon when they buy it next time, and you have to give them 50%. So this 50 cent to be used for the future service or future good. So this is what it means for free or reduced price. Should be considered as a two separate performance obligations. First, it is two separate obligations. They bought this one first. When they're doing the next one, you're going to reduce the price of the next one. So there is two separate performance. And now when it is saying that when a customer receives a coupon, that is a material right, since the coupon can be used to reduce the cost of the future purchase. The goods purchased and then coupon represented a separate performance obligation. So that's what it means. They're separate obligations. So now going further with the separate obligations comes as my warranties. So there's two type of a warranty. One is a service type warranty. The other one is called one is a service type warranty. The other one is as a service assurance type of warranty. The other one is a service type of warranty. Sorry, there's two warranties. One assurance type of warranty is an expense approach, where service type of warranty is a revenue approach. So those are the different ones. When we say assurance type of warranty, if you stand behind your product, means if you stand like a Black & Decker, when they sell it, they said within 2 years, if something happens to the product, you bring it back, they'll fix it for you. So that's called assurance type of warranty. Service type of warranty, you can sell the service. They're able to buy the warranty separately. If they're able to buy this additional warranty separately, then it's called an assurance a revenue type of warranty or a service type of warranty. So what we're doing at the when we're gonna, I think there's a question that we're gonna do. No, in this one there is no question, but I think there's a question in the back of the chapter that we will do. When a company sells a product with the warranty for 120 days and also sell a separate extended warranty for additional 3 years, the product and the 120 days warranty would be considered as a one performance obligation because they are interdependent. The 3-year warranty could be sold separately, so they can sold separately and they are not interdependent. So this, they can sell it separately. So this is what happens. There's when that happens is when you have an extended warranty. If you have an extended warranty, then it will be treated like a service type of warranty. If it's included in the price, then it will be treated like a assurance type of warranty. Going forward with the it is upfront fees are sometimes how do we recognize the revenue when it is given to us as an upfront fees? What is an upfront fees? Upfront fees are payments received before a product is delivered or a service is performed, like a membership fee to the gym. So that is an upfront fees, but they haven't used the facility yet, so that's what's called, that is upfront fees. So how do we record the upfront fees when it happens? IFRS allows this whole thing to be treated as a performance obligation. So what do we mean by that? So if you read this example, it'll make a sense from it. When a customer joins a weight loss group, the initial fee is non-refundable. So there is a cost of joining that group is $72 plus with an annual fee. So they have to join the group and then they have to pay $300 annual fee. So in this case, the upfront fees is the $72 is my upfront fees, plus they have to pay an annual fee. So altogether, what they have to do is they have to pay $372 if they wanted to join this group. So if they wanted to join this group, how long they're going to be joining this group? For a year. In this case, if you divide it by 2, and that is your $31, this is how their 31 is recorded as a revenue every month, and a revenue of 31 would be recognized each month for the first year. So this is what the revenue is going to record. So in this case, this is treated as a one performance. They have to pay the upfront fees, plus they have to pay an additional fee. So they in order to join, they have to join first and then they have to pay the fees. So they both are treated like a one obligation. So it is a one performance obligation under IFRS. Now going forward, what happens is that some long-term contracts provide a series of goods or services that are substantially the same over the life of the contract. Now, if you're going to be providing the same service over the life, then it is also treated as a one obligation. It also treated a one obligation. The example of that is that a company enters a 3-year contract. So this contract is for 3 years with a landscaping company. So you have with a landscaping company to take care of the plants or monthly fees. For a monthly fees, the monthly service are distinct as the customer benefit from them each month. However, because the service is essentially the same every month, they are combined into one performance. So then they have to they have to fix the monthly service is distinct, means they have to come every month. That's distinct. But are they providing a different service? No, the obligation is exactly the same. So that's another way of IFRS looks at it, that this is a one obligation. So what we're trying to do is, should we separate the performance obligation or should we combine them? If we separate them, we have to record them separately. If we can put them together, then we have to record as a one revenue. Now, the third step is the most important step in order for us to recognize the revenue. And there's three, that is a step three. Step three is the transaction price. So the price that we put on those revenues. Transaction price is the amount of consideration that a company expects to receive from a customer in exchange for transferring a good. Now, transaction price is stated in the contract. So it is stated in the contracts. In other contracts, consider the following. So it could be a variable consideration, it could be a time value, could be a non-cash consideration, or consideration paid or payable to the customer. So when we think of a transaction, our transaction price are stated. How do we calculate that consideration? There's four ways of calculating it. We're going to learn each one, so we're going to be learning in each one. These are the requirements under IFRS. So the IFRS can calculate the transfer price, transfer price using these four considerations. So that's used by IFRS. ASPE has little guidance. So ASPE doesn't have too much guidance. It's all depend on the judgment, what price are we going to put it in for the service. Now, when we talk about the variable consideration, sometimes the transaction price is depend on the future events. So future events, future cash flows. Then what happens, the company must estimate the amount of consideration to determine the amount of revenue to record, called a variable consideration. So if the transfer price that you are going to put it in for the revenue depends on the future cash flow, on the future events, what happens is that you must estimate the amount. Of course, if you're going to receive money in the future, you have to estimate the amount that you're going to receive to determine the amount of revenue to record. It is called a variable consideration, and there's two ways of calculating it. One is by calculating expected value, the other one is the most likely amount. Those are the different, there's a difference one. Sometimes you're given a probabilities of receiving that consideration, and sometimes you're given a most likely what you are going to be received. You're given a range. So in order for us to do this, we have an example that we are going to use how do we use these two methods. Now, in this case, contract to build a warehouse for 100,000 with a performance bonus of 50,000 based on the timing of the completion. So what we do is we have a contract to build a warehouse for 100,000. Top of that, we're going to get a bonus. So this bonus is based on this we are going to get for sure, but this 50,000 we are not sure when are we going to receive it, or if we're going to receive it. That depends on some of the probabilities. So in this case, performance bonus decrease by 10% per week for every week that we go. So when you have a construction, sometimes we are not on time. We would like to be on time. If we are on time, we're going to get the 50,000 for sure. But if you are not on time, what happens is that bonus gets reduced every week or construction that is late. So let's see what the question is saying. Probability the contract will be completed is 60% by the agreed upon completion date. So whatever completion date we set aside, there's a 60% chances it will be done on time. And there's a 30% chances it will be 1 week late. There's a 10% chance it will be 2 weeks late. And how do we calculate the expected value for our revenue? How do we do that? So now in cases, we know that there's a 60% chances we are going to receive 100,000 plus we are going to receive 50,000. If we do that, there's a 60% chances that we are going to complete on time. If we're going to complete on time, the transaction price will be calculated as a 90,000. If we know that it will be a 90,000 at the probability. If 30%, if we're 1 week late, so what happens is if you're 1 week late, our bonus that we're going to receive, it is going to be reduced. How much is it going to be reduced by? So you're going to get 100,000 plus what you have to do is the chances of that getting that is 30%. Chances of us 1 week late, the chances are 30%. But what we're going to do is we are going to reduce that 10. Our bonus is going to reduce by 10%, and we're going to get a 90%. So if we are supposed to get 100%, you minus the 10% of that, then we're going to get a 90%. If it's 2 weeks late, then we're supposed to get 100% of that bonus. But if it's 1 week late, they deducted the 10%. If it's 2 weeks late, they deducted the another 10%. That bonus, we are only going to receive 80% of that. So this is what they are doing, is that 80% of that. So, but the chances of being on time is 10%. So altogether, if you look at it, the probability is, now if you look at it, it is all equal to 100%. So this is all equal to 100%. The probability of being on time is 60%. The probability be 1 week late is 30%. The probability of 2 weeks late is 10%. So these are all probabilities. So then when you're given a probability to calculate the transaction price, you have to calculate it using the expected value. So this is what they did, is using the expected value, and they said that the transaction price will be 147,500 if we use the probability weighted amount. And sometimes we could use the most likely amount. So what happens is when you look at the most likely amount, will be by looking at the probability which is most likely. Of course, the first one is more likely, right? Because there's a 60% of the chances that we are going to the probability most likely we are going to complete it on time. So if it's going to be, this is the better method to use if the bonus is all or nothing. So in this case, if they told us that we're going to get 100,000 plus the 50,000 bonus. 50,000 bonus is dependent on when do we complete it. If it was given, we are going to get the bonus if we complete it 60%, if we complete it on time, or we're not going to get anything, then it will be the with this probability will be better suited for the situation. But in this case, they said that it's decreasing. So then the only one that is management will use is the management should update its estimate every reporting date, of course, because the probability can change. So then the only one that fits to do the transaction price is your expected value, which is probability weight. Now going same with the variable consideration, we're still sticking with the variable before we get to the time value and everything. So now in this case, there's a different type of variable consideration. So we know there's two methods, but there's a different types of consideration. The first type of the consideration that we're going to talk about is right to return. So in the contract, what we do is in the agreement, it allows the customer a right to return, has recognized the following. So what happens is they said that you can return within 30 days. So in this case, revenue from the sales of the product considered future returns. We have to record a refund liability and an asset for its right to recovery inventory. So if there's in our contract, if there in the contract there's a right to return clause is put it in there. How do we do our entries at the time you sell this product? So how do you do it at the time you sell the products? So this example is going to take us to this is the next example when the right to return clause is put it in as a type of our variable consideration. So the entries we do it under IFS are different from the one we do it under the ASPE. So we're going to do the transactions when there's a right to return clause is put it in the contract. So what happens is they're telling you how to do it, but we're going to do it in journal entry. So Vanden company sells 100 products for $100 each. So what we did is we sold it. What did we sell? 100 products, and the cost of each product is $100. So that's what happens in this case. Sorry, we sold 100 products, and each product is $100. So in this case, this is how we sorry, I thought I had a 100. So this is, we got a 10,000. So that's what our total sale is. But in this sale, we have a right, we have a sales contract that allows the customer a right to return has to be recognized. So in this, they had a right to return. How you know there's a right to return? It says that the company sells 100,000 products for 100 each to Amaya Inc. payable in 30 days. So in the contract, they are going to pay us in 30 days. That's why it's on credit sale. Vendor allows Amaya to return any unused product with 30 days and receive a full refund. So they have 30 days to get a full refund. So if that's the case, they have a right to return. So what we're going to do is they in 30 days they can return it. So in this case, the cost of each product is $60 from the past experience. It estimates that 3 products will be returned. So we estimated 3 products will be returned, so that we needed to record the refund liability till 30 days are over. So then how do we going to do it? 3 times the 100 we are going to record as a refund liability. Our sales revenue will be recorded for 9,700. So in this case, it will be recorded at a 9,700. This refund liability, we needed to keep it as a liability because it's in the contract. We have to set up a liability till the 30 days are over. So we have to keep them into the 30 days. Then this is what our next entry is. We're buying it $60 and we're selling it for 100. So in this case, we have to record the inventory. So what happens is the cost of the inventory was $60. So that is your $60. So then we also have to record the 3 products that they are going to bring back that is within the return policy. So in this case, 3 times the cost of those right to return goods. That's our estimated inventory return, and then the rest of the amount is my cost of goods sold. Now we're going to do IFRS, then we're going to move to our ASPE because otherwise it makes a little bit complicated. Now when an item is returned, so after the 30 days, what happened within the 30 days, they had whatever they could not sell. What they could do is they can return it for full price. So what happens is that one of the products, one item is returned within 30 days. If one item is returned, it costs them $100 and then it costs us the $60. So what we have to do is we needed to adjust our cost and what they return. So we put aside a refund liability. At this point, what we are going to do is we are going to adjust that refund liability by 1 unit. So debit the refund liability and credit will be accounts payable. Why we put it on accounts payable? Because they haven't paid us this when we set it up as this was accounts receivable. If this one was a cash, we will give them the cash back. Since our sale was on credits, then we have to put it on credit because we are not going to give them the money back till they pay us first. Then the second one is you return the inventory. The returned inventory will be a debit, and estimated inventory will be a credit for the 1 unit for the cost that we have. Now, when we go under the ASPE is what the ASPE is doing, that you record the sales, debit the accounts receivable, and then what you're doing is we are doing the return. You debit the sales return for allowance, and credit will be allowance for sales return. So in this case, it is a little bit easy to do it, and then you have the entry is same under the both methods. Under the both ASPE recognize the same. The only difference is one, we record a liability, and here we don't have any liability set it up. So whatever we set it up, we have to reverse what we did. Sometimes when we're talking about variable consideration, we sell to the customer that may given a volume discount. So if they buy a lot of item, or they're buying a lot from us, we gave them a discount. When we gave them a discount, what happens in that case is Sung Inc. offers its customer a 3% volume discount if they purchase at least 2 million of the products during the calendar year. By March 31st, 2020, they already bought 700,000 worth of the sales. In previous 2 years, Sung sold 3 million to Arctech and period from April 1st to December 31st. So we know that they are our good customers. If they are our good customers, what we could do is we have to provide them the volume discount. If we provide them the volume discount, how we recognize the volume discount is different under the both ASPE and IFRS. Now, in this when you're doing a CPA exams, you are given a CPA handbook. So then what you could do is you could you can visit the CPA handbook while you're writing your test. So it makes it a little bit easier, but the more questions you use, the better you're going to become. So now in this case, under the IFRS, what we are going to do is now we made a sale. When did we made a sale? We made it a sale on March 31st. The sale is for 700,000. They didn't tell us if it was a cash sale or on credit sale. So in this case, we recorded an on credit sales, debit the accounts receivable, credit the sales revenue. So what we are giving is we're giving them 3% volume discount. If you're giving them 3% volume discount, we have to set up a liability at this point. Why we have to set up a liability? Because we don't know if they're going to meet their purchase criteria that we put it in. They have to buy from us at least 2 million. They only bought 700,000 worth of sales from us. So we needed to record we needed to record what we're recording is we were recording this 3% of the liability, because it's in the contract. We are providing them the sales volume. So in this case, we cannot recognize all the revenue till 1 calendar year is over. When Arctech Inc. meets the threshold, Sung will make this entry. So when they meet the criteria, what they're going to do is they're going to credit the 700,000 and then debit the cash and debit your liability. So what happens is that now they met the criteria. So what happens is that we're going to receive cash from them. When they're going to give us a cash, we sold them a product for 700,000 and minus the 21,000 that the discount they're supposed to raise, they're going to give us a cash. They're going to give us a 679,000 worth of cash. But then my accounts receivable they owed us was 700,000. We set up a liability. Our liability will be reversed now. The liability was credit. Now we are going to be debiting that liability. So we are going to be debiting that liability. So in this case, it is going to be debiting that liability. So something happened. Oh no, it's back. Now how you do it under ASPE is just similar to what we did under the when you did the when you are given a how you record the refund liability is similar to that. In this case, what happens is debit the accounts receivable, credit will be your sales return and allowance return, and when they are using the 21,000 of the volume discount, your debit will be 679,000, and whatever allowance we put it aside, we have to clear it. But now they met the requirement for their volume discount. time value money, we have learned it, we have to make it to the present value. So any future cash flows, then we have to, when we are calculating the transaction price, we have to record them at the present value. So we have learned it in chapter 2 when we calculate the present value, but we're going to just do a quick visit to this. They're saying in most instances companies receive consideration after the product is provider or services are performed. The company provides short-term financing less than 1 year. So that's what happens. And then usually the time value of money is considered only if the contract, if time value is considered only if the contract involves a significant financing component. So what happens is, sometimes what happens is we have an account, so we provide the sales, so we have a sales revenue and we have an accounts receivable. If the company doesn't have, when the time value comes into play, is if you're going to get a interest in the futures, that's when it comes into play. Is in this case, I think I didn't discuss this one. I wanted to do this before I show you this. When a sales transaction involves a significant financing component, the amount of revenue is determined by discounting the payment. So you're going to receive payments, but you're going to receive it in the future. But when you're going to receive when you receive the payments in the future, what you're going to do is that you're going to receive a series of payments, but you're going to receive it in from the future. So what you need to do is discount it to today, and when you're discounting it today, that's what you record. That's what you have to record your that's why it's called the time value. When we think of that, the example that I wanted to say was that for example, you're going to get a accrued if the same example I wanted to use, it was you have a accounts receivable and your sales. So this accounts receivable, if they didn't have the money, but what happens is that the consideration, they are going to give it to us that later on, because they are going to give it. Accounts receivable is when you sell something on credit. Instead of accounts receivable, what they did is they give us a notes receivable. When you have a notes receivable, we have an interest bearing notes receivable. You're going to receive interest payment. Those interest payment, we needed to calculate it using the time value to the present value. So in this case, if when this happens is when you have your transaction price, you calculate the transaction price using the time value. Time value is when you're going to receive the money in the future, and they are to be discounted. And if they are going to be discounted, then we needed to use a time value to calculate the transaction price. Then we have to calculate the transaction price. Means we're going to get extra money when the consideration is paid over time, and you're going to be receiving an accrued interest in the future. The discount rate reflects the customer's credit risk. The report that affects as either interest expense or interest revenue. So what I wanted to say was that we are going to be receiving in the interest. So in other words, we are going to be receiving interest. We're going to get more money, and we're going to get a series of payments. They need to be present value. That's what all I wanted to say. And sometimes the consideration, when the company receive consideration, if it's a non-cash, means it is not given to us in cash. If it's a non-cash, what do we do in that case? When company receive consideration in form of goods, service, then if they're giving you goods or service or a non-consideration, they will be recorded at a fair value, and fair value of what is received. So when you record that revenue, you will record it at the fair value of the service that we are receiving. Going forward, the next one is that consideration paid or payable. Consideration paid or payable. Consider paid or payable covers items like vouchers, coupons, or gift cards. So gift card, Christmas is just gone by. The gift cards are the good example to use. Sometimes we're given a consideration in a gift card. So whenever that happens, how do you record your contract liability? So Ocean Limited sells $500 gift cards to a customer on January 1st. So what happens is we sold it, but they are not going to come back till the customer brings it back. So what we had to record it on January 1st, we are going to record the cash and the contract liability. We cannot record the revenue till that contract till the person brings the card back with no expiry date. Based on the past experience, 85 of the gift cards are redeemed and 50 are unexercised. On December 31st, the customer make one purchase of $50 using the gift card. So now when the gift card is purchased, contract liability is set up. So in this case, we have a contract liability. So what we are going to do is when we are doing is here, we are going to debit the contract liability and record the sales revenue. So how are we going to do it? So we sold the gift cards. We sold a gift card for $500. So we know that 85% of the gift cards will be redeemed and the rest will not be redeemed. So when you're doing it, 85% will be due. So the total gift cards were 100% was $500. But then we know that we only from our past experience, 85 are going to be redeemed. So 500 times the 85, we needed to prorate this gift card that we're getting. In this case, that will be 425. So when you do that, you want to know how much of that liability should be recognized as a revenue. So when we estimate 85%, so we can only recognize 85% of the 500. You have to prorate it. When you prorate it, the liability will be your $50 times the total liability divided by the estimate. So in this case, divided by the estimate, and that will be debit the contract liability and credit will be your sales revenue. Now, allocating the transaction price to separate performance obligation. Transaction price are allocated to more than one performance obligation in contract based on a relative fair value. Sometimes we have to when there's more than more than one performance. If we have more than one performance obligation, what happens? So then in the contract, then what we have to do is the transaction price is calculated using the relative fair value. So of course, the best measure of fair value is what the company could sell the good or service on its standalone. And then sometimes this information is available to us, sometimes it's not available to us. If it's not available to us, then all information that is available, like market condition and type of information, should be used. If we are given, best measure is fair value of the standalone basis. If that's not given, if that's not available, of course this is the best one. If it's not used, then we have to still calculate the transaction price. And then what you're going to do is you're going to use other information that is available to calculate the transaction price. Now, how do we calculate it under this? First one is to using the fair value is what the company should sell the goods or service on a standalone standalone basis. So let's look at it, what the question is saying, and then see if we can pinpoint where we're going to go with it. When sum of the value of each goods and service in the bundle is greater than the transaction price, the total revenue transaction price should be allocated to separate performance obligation based on the relative value. So what happens in this case? So in this case, when you are selling as a bundle, so in this case, the best measure is the fair value, is what the company could sell the goods or service on a standalone basis. So what happens? I think I missed the slide here, but I could be wrong. But let me see what the question is asking. The total revenue / transaction price should be allocated to the separate performance obligation based on the relative value. So we have a performance obligation 1. Oh no, I think it's here. So when we have the purchase price is the $2 million. The performance obligation of one is 2 million. Performance obligation of the two is 20,000. Performance obligation of three is 50,000. Sometimes we needed to calculate the transaction price of the separate performance when they're put it in together. So how do we calculate the price separate for each one when we are selling them as a bundle? You have seen it when you sell a building. In that building we have a land, and then we have other things in it, so land improvement, all those other things. When that happens, is the purchase price is 2 million. That's the price, the transaction price, but we needed to allocate it to each performance, to each revenue. When that happens, is first you needed to calculate is that if you were to sell this performance on its own, what is the cost of that performance will be? What will be the price of those performance? The price of the performance one will be 2 million. For the two will be 20,000. Three will be 50,000. Altogether is 2,070,000. What you're going to do is first you're going to prorate it. How you're going to prorate it? The value of your first performance divided by the total performance, and that will give you 96.2%. And you're going to do the same thing for the second one, 20,000 divided by 2.7 million, and that will be your 10. I think I have a lot of zeros in here. No, I don't. I have a one extra zero. So that will be your 0.9%, and then you have your 2.41%. This is equal to 100. The purchase price, the transaction price is 2 million, and then you have to multiply it by the purchase price to get the price of the transaction price for each performance. So sometimes what you do is when you sell when you sell different performance in one purchase price, how do we allocate the price to the other performance? So that's what we are trying to do here. And then sometimes what happens is that, sometimes what happens is we sell as a bundle. So let's look at it. I wanted to get to the bundle before we get to it. I know it seems like a long chapter. It is a long chapter. Now, sometimes how do we calculate the transaction price to separate performance obligation if we were selling it when a selling price of a bundle is less than the individual standalone? So when you sell it as a bundle, of course we wanted to sell it at cheap. How you are going to calculate the transaction price of each performance? So how you're going to calculate the transaction price of each performance if we are selling at a bundle? The bundle is cheaper. So that's what happens if the bundle is cheaper. If the bundle is cheaper, how do we calculate it? In this case, what you're going to do is if you sell as a bundle, if you sell the bundle 2 and 3, if you sell performance 2 and 3, it will cost the customer $550. If they sell the bundle as a performance 1, 2, and 3, that will be the cost as $650. So in this case, what happens is based on the separate bundle price, there's a difference. What is the difference? If they get the all 3, they'll get it for $650. If they get those 2, they'll get it for $650. So the difference between the discount is $100. So this difference in the discount applies to the performance obligation of 2 and 3 and should be allocated accordingly. Now in this case, performance obligation is 100. Performance obligation 2 and 3 should be 50. So in this case, the discount will apply to if they were to sell it as a bundle. So the bundle price of these two is $550. And there's the bundle for all 3 services is $750. But if we're selling them all 3, we're giving them $650. When you do that, your $100 will apply to performance obligation 2 and performance obligation 3. In this case, what you're going to, when you're recording the revenue, the transaction price, the performance obligation of your 1 will be 100. The performance obligation of your 2 and 3 will be $550. So when you record those two as a bundle, altogether the transaction price will be $650. So that's what that's how we're gonna be recording our transaction price. Going further, now we are at once we figure out the transaction price, what we are gonna do is the company satisfies its performance obligation when the customer obtains control of the goods. Now, the company has once they have the control over the good, the company has the right to a payment. The company has transferred the legal title. The company transferred the physical possession to the customer. The customer has the significant risks and rewards. So now, if they got the good and they put that good in the warehouse, it's their responsibility. They have had the significant risk and reward. They're using it to earn income. Customer has accepted the asset. If they put it in their warehouse and they're using it, that means they have accepted the asset. So now going further, the company recognized revenue. Sorry, the company recognized the revenue. Okay, we are at the earning approach. Let's see. The company recognized revenue for the performance obligation under time by measuring the progress towards completion. To the determining factor is still transfer of control from the company to the transfer. So sometimes what happens is recognizing the revenue when each performance obligation is satisfied. Sometimes we measure the transfer price according to the performance obligation, but then we needed to know when are we providing these obligation services. So when do we record the revenue? So sometimes this is an example. What we have is the price of 2-year contracts is $300,000. So it's a 2-year contracts and the price is $300,000. So they pay upfront $6,000. The payments per month is $1,000. Revenue per month is $1,250, and the first payment is $700. So how did they get the revenue for the month? So when you do that, we know that if you have $30,000, that what we are good. The contract is $30,000. This contract is for 24 months, and then every month we are going to be recording the revenue of $1,250. So in this case, when you receive the money for the first payment at the beginning of the year, we signed the contract what they did is they gave us a first payment. We haven't provided them the service yet, so what we're going to do is debit the cash because they gave us a cash. Now the unearned revenue, and then we have a earned revenue. So in this case, $1,250 will be earned every month, and then we have an unearned revenue for $5,750. So that what happens is when we're recording the first payments, we have to record an unearned revenue. So the only revenue that can be earned is that what we are doing is the total price is divided by evenly over the 2 years. So one obligation is filled. Journal entry for the first payment. So that will be the journal entry first payments. At the end of the month, what you're going to do is you're going to debit the unearned, and then you're going to credit the revenue for that. So you're going to debit the unearned and then credit the service revenue when you provide the performance obligation when the month is over. ASFE uses the earning approach. IFRS uses the IFRS 15, which there's 5 steps to recognizing the revenue. Under the earning approach, it's a little bit easier, and it's saying there's not much guidance there. Revenue for the sale or goods are recognized when the following criteria is met. You can record the sales at the time the risk or rewards are transferred to the buyer. If the risk and rewards are transferred to the buyer, or seller has no continuing involvement in nor effective control. So seller, as a company, we have no involvement. Cost and revenue can be reliable measure. You can see the cost of it and the revenue from it. And collectability is probable. Once that happens, we can recognize the revenue at that point. this is a consignment sale. Sometimes you have goods, and then what you're doing is you make a deal with another company or another store to sell your product on their shelves. So if, for example, you're selling their products on your shelves. Now, in this case, they are called consignment sales. Manufacturer or wholesaler consigner deliver goods to the dealer consigning, but retain title until they are sold. So that in this case, sometimes if you think about it, if you go to the grocery stores, if you see that, I'm just saying, a Coca-Cola is putting their Coke in there. When they're putting their Coke in there, they are at that point, what they do is they will you see them loading on the shelves. What happens is their manufacturer or the wholesalers deliver goods to the dealer, and they are the consignees, but remain the control until they're sold. Who the consigner is, in this case, our example I used was Coca-Cola. They are the principal, and who is the consignee? They are the middleman. So they are the selling the products to the customer. So we go buy the Coca-Cola bottle from the no-frill, so that no-frill is the middleman. So they are the agent. Inventory is carried on the books of the consigner. The wholesaler or the manufacturer records the books, not the consigning. So now what happens is when the consigner does is, the consigning, what they do is accept the merchandise and then agrees to exercise due to diligence in caring for selling it after the sale. Consigners. So now these are the thing. This is the process. What they consign when there is a consignment sale. That's the process they have to do. So now the best way to do this is do it in an example. So now we are going to do it in an example. We're going to follow these 1, 2, 3, 4 steps, and how we're going to when do we recognize the revenue. So in this case, the consigner company ships merchandise costing $36,000 to the consignee on consignment to the consigning store. So that's our first thing. Is what we did is the consigner as a company, what they did is they ship. At the time they ship the goods, what happens is the shipment. So you have to do the entry under the consigner and the consignee. So what we had to do is we take it out of the inventory. What we do it, we put it into our inventory. We still have to account for that inventory, but it goes under the inventory on consignment, and credit will be our finished goods inventory. They haven't received it, so then no entry. They will just record a memo entries because they haven't received the inventory yet. So they shipped it, but they haven't received it. Consigner pays consigner, the owner of the inventory, pays $3,750 freight costs, and consignee pays $2,250 for the local advertising costs that are reimbursed by the consigner. So first, what we are going to do is we are going to pay the freight charges. So then it is a cash, and debit will be inventory on consignment. Now there's no entry because they're not paying anything for the for the freight. Only the consigner is paying it, but the consigner is paying for the advertising. So if they paid for the advertising, they're going to receive that money later on. So in this case, you'll do it in the books of consigner because they paid cash and they paid for the advertising, but they're going to receive that money from the consigner, but that is going to be done later on, but by the end of the period. By the end of the period, consignee has sold 2/3 of the consigned merchandise, which is for $40,000. So in this case, now we have to do an entry under the both books, and sometimes it's nice to see it from the point of view of the consignee before we get to the consigner. So what happens is what they did is consigning. What they did is they sold it. If they sold it, now what happens is that they are going to be receiving. They have to record a receivable because they sold it for how much? They sold it for $40,000. So in this case, they received it, debit the cash and credit the accounts receivable, but there's no entry at this point because they haven't given them the goods. From that, what you're going to do is, if they have the money they collected, from the customers, that wasn't for their inventory. All they're getting in between is a commission from the people. That's what they're making their money from, the commission. So they're not making any other money, they're making the money from the commission. First, what we have is this money they owe to the consignor. So first they're going to do is, the money they received from the customer, they're going to debit the accounts payable. So that's the first thing they're going to do. The second thing they're going to do is, for the advertising that they did behalf of the consignor, they want that money back. So if they want that money back, what they're going to do is, they are going to credit that accounts receivable. Now is the time for them to collect that money. So the products they sold was for $40,000. From that $40,000, they are going to take $2,250. That was for the advertising. So they're going to take that money. Also, of course, they're not going to do anything for free. What they need to do is, they have to get paid for their commission. How much is their commission? The $40,000 they sold, their commission is 10%, so they want $4,000 from them. So then the cash they're going to give them is the difference between those two. That is $33,750. So in this case, they have a commission revenue. It's called that revenue from consignment sale, which is $4,000. That is your credit. Your accounts receivable is a credit, and your cash is a credit. Now they paid cash. They are going to be receiving cash. When they receive cash, and they will record the advertising expense, because only now they're going to they paid them. So what they are going to do is, they are going to be recording an advertising expense and a commission expense for that point, and then credit will be your $40,000. Now, if it's a consignment, we only sold 2/3 of it. What we needed to do, and we needed to do an adjusting entry at the end. How do we do an adjusting entry at the end? What we did is, we sold it for the 2/3 of the consigned goods are sold. If 2/3 of the goods are sold, what we needed to record is, we needed to record an entry for the 2/3. So how do we do it? In this case, is that when our inventory and consignment, how much was that? Our inventory and consignment was $36,000. Out of that, 2/3 is sold, and then that's what we had to take it out, in 2/3 from that. So that should come up with the $26,500. We take it out of the consignment, and we debit the cost of goods sold, but there's no entry to be recorded under the under the consignment sale. I'm going to stop the recording here. The next part of the question is that we needed to do percentage of completion and completed contract, and we have to do a zero profit. So that will be for our next recording. I'm going to stop this recording here. Thank you for listening to me. Do like the video. If there's anything you want me to change, or if you have a feedback, do provide me with the feedback so that I can improve for the next time. Thank you so much for listening to me. If you have any question, to ask me in the class, or you could write a note on the YouTube video underneath a comment. Thank you.